Most people invest hoping to buy low and sell high. But what if I told you there's a way to flip that completely? Sell high first, buy low later, and profit when prices crash. It sounds backwards. It feels like betting against success. And yes, it can go spectacularly wrong. But it's also how some traders made fortunes during the 2008 crisis while everyone else was panicking. Today, I'm breaking down short selling, the strategy Wall Street pros use to profit from falling prices. I'll show you how it actually works, the legendary wins and catastrophic losses, and most importantly, how to approach it without destroying your account. Welcome to Invisible Income, where we turn simple, repeatable systems into real online revenue. No hype, just clear steps and proof. Let's get into it. Here's the big idea in plain English. Short selling means borrowing an asset you don't own, selling it immediately at today's price, then buying it back later, hopefully cheaper, to return it. If the price drops, you pocket the difference. Think of it like this. Imagine borrowing a limited edition sneaker from a friend. You immediately sell it online for $300. A week later, the hype dies down and you buy the same sneaker for $200. You return it to your friend and keep the $100 profit. But here's the catch. If that sneaker suddenly becomes more popular and the price jumps to $400, you still have to buy it back. Now you're losing $100 instead of making it. Let me put real numbers to this. You borrow 100 shares of a stock trading at $50 each. You sell them immediately for $5,000 total. The stock drops to $30. You buy back those 100 shares for $3,000, return them, and keep $2,000 profit minus fees. But if the stock rises to $70 instead, buying back costs you $7,000. You just lost $2,000. The math is simple. The emotions, not so much. So why would anyone do this? Two main reasons. First, speculation. You've done your research and believe something is overpriced or heading for bad news. Shorting lets you monetize that view. Second, hedging. Let's say most of your portfolio is in tech stocks. You're worried about a potential downturn, but you don't want to sell everything. A small short position can act like insurance. It offsets losses if the market drops. Now, how does this actually work behind the scenes? You need what's called a margin account. Your broker locates shares and lends them to you. While you're short, the broker charges you a borrowing fee. If the company pays a dividend while you're short, you owe that dividend payment to whoever lent you the shares. And because you're borrowing, the broker requires collateral. If your losses start mounting, they can force you to buy the shares back immediately. That's called a margin call. Now let's talk about the stories, because this is where short selling gets really interesting and really dangerous. Case 1. The Big Short. Before 2008, a handful of contrarian investors studied subprime mortgage contracts. They read thousands of pages of loan documents, modeled default rates, and concluded the housing market was about to collapse. They shortened mortgage-backed securities. When the crisis hit, those shorts paid off spectacularly, billions in profit. The lesson? It's timing plus thesis. They had rock-solid research and structured their trades to survive the wait. If your short is based on vibes or Twitter outrage, you're gambling. Case 2. GameStop and the short squeeze. Early 2021, GameStop was heavily shorted by hedge funds. Then, retail traders on Reddit coordinated a massive buying campaign. The price exploded from $20 to nearly $500 in a few days. As the stock rose, short sellers panicked and rushed to buy shares back. That buying pushed the price even higher. More shorts got squeezed, more buying. The loop fed on itself. Some hedge funds lost billions. The lesson? Never short crowded trades without an exit plan. When borrow costs are sky high and the story is emotionally charged, you're one tweet away from disaster. Case 3. Enron. Forensic short sellers dug into Enron's accounting in the early 2000s. They found inflated revenues and hidden debt. They went public with their research and shorted the stock. Enron eventually collapsed to near zero. That's short selling at its best. Research that exposes something real. A great short is a research product first and a trade second. So how do you actually use short selling without self-destructing? Here's a simple playbook. Step 1. Decide your purpose. Are you hedging or speculating? If it's hedging, keep it small. If it's speculation, your thesis must be specific. Flawed business model, unsustainable debt, or a clear catalyst like missed earnings. Step 2. Choose your instrument. A direct short has unlimited loss potential. If that bothers you, and it should, consider alternatives. Buying put options caps your loss at the premium you pay up front. Inverse ETFs offer short exposure without managing borrow fees. Step 3. Build your risk frame. Size small. Predefine your maximum loss in dollars. Set a stop loss that respects the stock's normal volatility. Let me stress test this with numbers. You shorted at $50. It spikes to $65. You cover. That's a $15 loss per share. Now imagine it spikes to $95. That's $45 per share. If you shorted 100 shares, you just lost $4,500. This is why pros size small and use defined risk structures. Let me give you the red flags that make a short extra dangerous. High short interest relative to available shares. When too many people are already short, you're setting up for a squeeze. Stocks with cult followings that can be coordinated on social media. We saw this with GameStop and AMC. Upcoming catalysts like earnings reports or product launches. These can trigger sudden moves. And if you're shorting crypto, that's expert mode. 24/7 markets, high leverage. It's like learning to drive in a snowstorm. So when can shorting actually help regular investors? Hedging concentrated exposure. If your net worth is heavily tied to one sector, buying puts around earnings can soften a bad quarter. You're not trying to nail the crash, you're trying to reduce regret. Here's your field guide. Pick one ticker you actually understand that looks stretched. Write a one-page bear case, price to sales versus peers, cash burn, customer concentration. Be specific. Choose a defined risk structure, a 3 to 6 month put option at a strike that matches your thesis. Size the premium at 1 to 2% of your portfolio. Once you enter, pre-commit to either roll it or exit on a specific calendar date. Don't let one scary green candle make you panic. You don't need to be a hero. You just need to avoid the trap that ruins most beginners. Oversizing naked shorts and names that can squeeze. Let me be clear. Short selling is advanced. It's not where most people should start their investing journey. But understanding how it works, that makes you a smarter investor. You'll recognize when stocks are overcrowded. You'll spot potential squeezes. And if you do decide to try it, start small. Use defined risk. Let research, not adrenaline, drive the trade. Now here's the thing. Short selling is one tool in a much bigger toolkit. But most people never build that toolkit because they're stuck consuming content without a system to actually apply it. That's exactly why I created the Invisible Income Starter Kit. It's not about shorting stocks or complex trading. It's about building simple, repeatable systems that generate real revenue. The kind that keeps working even when you're not actively grinding. Inside, you get ready-made scripts for social posts, emails, and ads. You get AI prompts to create endless variations in minutes. You get an automatic tracker to measure what's actually working. And you get a 7-day mini guide that walks you through applying everything step by step. No theory overload, no months of courses. Just clear steps you can start using today. The link is in the description. Grab it, test one script this week and see what happens. Whether you're exploring shorts, building digital systems, or just trying to make smarter money moves, the key is always the same. Start small, measure everything, and let the data guide you. If you want me to break down a live bear case with options in a future video, drop a ticker in the comments. Thanks for watching. I'll see you in the next one.